This might be one of the most important videos I've ever done to date. The unsexy part of trading that no one really talks about too much is risk management. But today we're going to go over how focusing on that side of trading can take almost any trading strat and make it instantly better. And also a way to quantitatively compound returns. So, whether you're growing a small account or whether you want to continue to grow a larger account, this simple technique, I think, will help rethink about trading in your mind and help give you a nice quantitative approach in order to push your trading forward. So, first, let's define our trading before going into a deep mathematical dive of its benefit. So, R, when traders talk about R, it's a simple calculation that defines the risk versus the reward on trading. When talking about trading, this is how we talk about what we're risking versus what we're making. So let's just start with a simple example. Let's say someone makes 200 bucks on a trade. They come to you and say, "Hey, I made $200 on a trade." Without you knowing the risk side of that, it's a useless number. You don't know how much you risked on that trade. So if you risked $1,000 to make that $200, it was a bad trade. If you risked $100 to make that $200, then that's a great trade. So say you told me that you risked that 100 to make 200. That's again a great trade, but even that 200 number is kind of useless depending on your account. A simpler way to say would say I made 2R. So when you see people talk about R multiple trading, they're basically just saying that without telling you the amount of money I made or lost, because that's going to be solely dependent on your account size, which we'll talk about in a minute. You're basically just saying, hey, I risked 1 unit of risk, whatever that is, $100, $1,000, $1,000,000, just based off the size of your account, and I made two. So it's a very simple and standardized way at looking at risk reward. So that's all well and good for when someone is talking to their friends or other people about trades they made. But what about people who don't? Why would they care about this? Well, because framing trading in this way is the best of many worlds. Firstly, it means that you're framing everything in terms of risk. So then instantly you had to have an initial risk in mind on every trade. Right off the bat, I think that elevates most traders, most newer traders to from where they are. Just instantly as framing risk in that way. By using R, you can easily see whether your trading is good or not. If you just look at your P&L at the end of the day or week or month and say, "Oh, well, I made $20,000 this month. That's going to be a good month." But without calculating that R number, you could have been risking $100,000 to make that $20,000. That's not nearly as good of a month if you think of just compounding that out over time. So how do you calculate R? And why is R compounding so powerful? And we're going to show how insanely powerful this is just in a minute. So let's say you used to have a $100,000 account. So first you need to pick how much of that account you're willing to risk on any given trade. I've heard people use numbers as high as 2%. I certainly wouldn't say that going above that would be the best for some. It could be good for some. But I use around 0.5 to 1%. So for this example, let's say 0.5%. So you would just take the value of your account and you would use that to calculate the dollar risk per trade. So here you would just take the size of your account and you would multiply it by that risk per trade to get a dollar number that you're going to risk on every trade. So let's just start $500, which is 0.5% of a $100,000 account, the example I used above. If you're using Trade Ideas and Brokerage Plus to trade, you're done there. You can just put that into the system and it will do the rest of the math for you. If you're not and you're interested, links are in the description below that will save you some money on that. And that's also an affiliate link, so it helps out the channel. If you're not using Trade Ideas, then what you need to do is just add another layer of math to that. So you take that $500 that you're risking, you then take how much your risk is on that trade. So let's say the entry price is $10 that you're looking at that trade, and your stop loss is $9. You know you're risking $500 on any given trade. So by dividing those, you can say, okay, I want to take 500 shares on this particular trade so that if I get stopped out, that's what I lose. Now that you have that R number, you can compare all of your successful trades versus that number. You'd never want to see a loss lower than that number. It means something went wrong and you should take a look at that. And you want to see your average gain be well higher than that number. This means that if you at least maintain a 50-50 win rate throughout your trading career, in the long run, you'll make money. Now, let's talk about the most powerful part of this thinking, which is the way our multiples can compound in your account. So first, check out this chart I made here. Using this concept of a $100,000 account, risking 0.5% of that account on every trade. So we're risking $500 on every trade. We are trying to shoot for 2R. So these 4 lines you see on this chart are different trading scenarios. Again, all with a 50-50 win rate and a 2-to-1 risk reward. So you're trying to make 2R and you're always risking 1R, and that R is always $500. You can see just by trying to achieve double your risk how much better these trading graphs look already. Again, this is all in theory, but I think most people would be happy to have equity curves that look like this. Now, let's check out this chart. So instead of keeping the risk and the return the same, what I'm doing is I'm recalculating after every single trade my account value, and then I'm recalculating what that R is on every single trade. So, for example, if you had that $100,000 account, you risked $500 in the first trade and you made $1,000. Now you have $101,000 account. You would then put that account into the next trade, risking now the new amount that you risk. And as you keep going, that risk increases. So every time you lose a trade, you decrease your risk a little bit. And every time you make a trade, you increase it. Now, I know this chart is exaggerated for effect. And the reason we can tell that is those 4 scenarios in the last chart are still there. They're just unable to be seen because of how dramatic the compounding will change what it is that you're looking at. So what's happening here is since you're recalculating your risk on every trade, you're able to make sure you're compounding your return by taking a greater dollar risk as your account increases, but the same percentage risk of your own account. So the benefits here are threefold. One, you always keep a constant percentage risk. I've mentored a lot of traders, and I have Stats Edge Pro, which you can come check out my website and the link in the description below, where I talk to traders daily and they get to look over my shoulders while I make trading decisions. And I have never heard a horror story once of a trader who said, hey, I had a constant percentage risk per trade, and I followed that religiously, and I had a trading plan of when to enter and when to exit, and I followed that as well, and I blew up my account. I've never heard that story. I've heard the story a lot of, I didn't have a plan, I blew up my account, or I had a plan, it didn't have risk management, I blew up my account, or I had a plan, I didn't follow it, and it blew up my account. The second major benefit to this is that because everything is looked in risk reward terms, you can look at a trade and instead of wanting to bail on a trade because you're up a random amount of money, it makes sure that you're always focusing on, am I making more than I'm risking on this trade? Before I want to consider exiting, is there a reason that's going to push me out of this trade before I get to over 1R, over 1 times my risk? So the third benefit of this is as your account size increases, because hopefully you're making good and sensible trades based off your own trading plan, as your account increases, the amount of money that you're able to risk on every trade, so the amount of money you make on your good trades increases. That's the perfect world and what we want to have happen. The other benefit of this is for new traders or periods in which you're struggling, which happens to all traders, you're decreasing your risk. So there's never going to be a point where you're going to blow up your account, because as your account shrinks, the amount of money that you're allocating to every trade shrinks along with that. And then as you kind of figure things out and things increase, the amount that this is increasing is going to benefit as well. So try this out with your own trading strategy. Do some testing, see if it works for you. If it does, implement it in your real trading. And comment in the comment section down below your thoughts, whether it worked for you, whether you came up with another way to manage risk, how all that's working. If you like this kind of one-on-one educational content, please let me know by liking it and sharing it around. I really do read the comments, look at the likes, and try to judge what I'm going to do next based off what you guys want to see. So, again, thank you for watching. See you guys in the next one, and trade safe out there.